Good day. My name is Rossouw, and I'm a portfolio manager with Adviceworx Private Client Securities. I'd like to spend the next quarter of an hour talking to you about the global COVID-19 pandemic and the impact that it's having on investment markets. I'd also like to share some thoughts with you on how Adviceworx sees the way forward. This week, US President Joe Biden announced that all American soldiers would be withdrawn from Afghanistan by the 11th of September, the 20th anniversary of the Al-Qaeda attacks on New York and Washington. The US military effort in the Central Asian country has cost an estimated $900 billion without succeeding in either of its twin aims, namely to crush the Taliban insurgency and creating a united and democratic Afghanistan. Apart from 2,500 American soldiers and airmen, more than 7,000 soldiers from other NATO countries currently serve in Afghanistan, and they will presumably also return home. As of Thursday night, nearly 140 million people have been infected with COVID-19 worldwide, and over 3 million people have succumbed to the disease. The United States remains hardest hit, with 32.2 million infections and 579,000 deaths. India, Brazil, France, and Russia now make up the rest of the top 5, and South Africa is mercifully down to the 20th most cases in the world. As was expected, the latest wave of COVID-19 infections in India is spreading like wildfire. On Thursday, more than 180,000 new cases were recorded. The US and Brazil seem to have flattened their curves to some extent, but despite the third national lockdown, new cases are spiking alarmingly in France. Also concerning is the recent resurgence of the virus in countries like Iran, Argentina, and Peru, which are financially vulnerable and have poor health infrastructures. All in all, more than 700,000 new cases were recorded worldwide on Thursday, and this means that the daily infection rate has doubled over the past 2 weeks. 14,000 new deaths were reported worldwide on Thursday, with Brazil suffering nearly a quarter of these. Equally concerning is the sharp rise in the daily death toll in India, which has more than doubled since the beginning of April. Mexico, Poland, and France have also seen significant increases in mortality rates, but for now Brazil remains the epicenter. In Sao Paulo and Rio de Janeiro provinces, the daily COVID death toll currently exceeds the daily number of babies born there. As of Thursday night, 841 million people, or around 11% of the world's population, have received some form of COVID vaccination. Nearly 200 million of them are residents of the United States. China has thus far vaccinated 180 million of its people, India 115 million, Britain 41 million, and Brazil 32 million. Europe continues to battle to streamline vaccine rollout, and some countries have now paused the administering of the highly effective Johnson & Johnson vaccine because a few recipients have developed blood clots. There are plenty of signs that inflationary pressures are building in the United States, not least the sharply higher consumer price inflation number in March. To this can be added strong growth in retail sales and a ballooning trade deficit, both indications that US consumers are resuming their pre-pandemic spending patterns. The Chinese economy is also experiencing inflation, with producer price inflation up sharply in March, mainly due to rising fuel and food prices. OPEC is looking forward to further rises in the oil price, and President Biden's plan to raise company taxes is not popular everywhere. US consumer price inflation, the dark blue line, rose sharply in March, but a closer look at its constituent parts offers some good and some bad news. The bad news is that producer price inflation, the green dotted line, was much higher than consumer price inflation. PPI is a leading indicator of future CPI, and this would seem to imply CPI of more than 4% later this year. The good news is that core CPI, the light blue dotted line, is nearly a full percentage point lower than headline CPI. Core inflation excludes volatile items like fuel and food. This might mean that CPI will stop rising once fuel and food prices start leveling off. One of the key drivers of the strong global economic recovery and the current equity bull market is that credit is cheap. Real bond yields, that is the nominal yield minus inflation, are low in historical terms nearly everywhere in the developed world. In countries like the United States and Germany, real yields are in fact negative, and this enables governments to spend lavishly and corporates to borrow money for further expansion. Should inflation rise significantly and stay higher for longer, it would result in higher bond yields, which would put an end to the current benign environment. There are growing signs that consumers are beginning to realize that climate change is a real threat and therefore are prepared to embrace so-called green technologies. A good example of this is the growing popularity of electric and hybrid cars. This infographic depicts the number of new car registrations in Britain by propulsion mode and shows that over the past year, sales of plug-in hybrid cars have nearly doubled. Battery electric cars have increased by nearly 75% and traditional hybrids by nearly 12%. By contrast, 28% fewer petrol-powered cars were registered, while diesel registrations have nearly halved. Most Western equity markets had a strong week, with the S&P 500 reaching its 22nd new high for the year to date. On Wall Street, the rally was driven by technology and financials, while cyclical sectors did best in Europe. The US dollar has softened on the news of continued Fed stimulus, and US bond yields are lower. The price of oil continued to rise in anticipation of growing demand, and big American banks are more profitable than ever. Meanwhile, in China, the government continues to crack down on internet businesses whom they deem guilty of anti-competitive behavior. Amidst a continued global equity bull market, Chinese exchanges continue to lag the rest. The South Korean Kospi index, on the other hand, continues to benefit from strong demand for microchips and electronic appliances. The Kospi was the week's top performer and mainland China's A50 the worst. For the year to date, the US mid-cap Russell 2000 edged out the JSE's top 40, with the A50 bringing up the rear. Over the past 12 months, the Russell 2000 is top and Hong Kong's Hang Seng bottom. Over 3 years, the Nasdaq leads the pack, with the Hang Seng the wooden spoonist. An interesting, and some would say worrying, development of late is that even as indices like the S&P 500 keep reaching new highs, the daily volume of trade has been steadily decreasing. Over the past month, the S&P 500 has had 10 record closes, while at the same time the average volume traded per day has more than halved from 16 billion shares to less than 8 billion. Another interesting perspective on the state of the global economy and investment markets is the ratio between the total market capitalization of the world's stock exchanges and the value of the world's GDP. As of this month, the value of the world's shares is nearly 1.25 times that of the world's economy. The last time equity investors were this exuberant was on the eve of the global financial crisis of 2008 to 2009. Let's hope it's not an omen. On commodity markets, oil has been the standout performer for the year to date, with gold and silver the laggards. Steel and copper have also advanced strongly, buoyed by the prospects of growth in manufacturing and expanding US infrastructure spending. Of the platinum group metals, Platinum has faltered after a strong start to the year, but over the past month, palladium has gradually come to the fore. The IMF believes that global GDP growth this year will be the strongest in decades, with next year less so but still robust. The pandemic seems to have left few long-term scars on the global economy, and it is too soon to tell whether the current recovery is sustainable over the long term or merely a reaction to massive stimulus. Although inflationary pressures are building everywhere, these should recede as supply chains normalize. Average developed market inflation over the next few years will, however, be a bit higher than in previous decades, but runaway inflation is unlikely. Given the extent of inflationary pressures, central banks will probably have to start hiking interest rates sooner than they're currently saying, but later than what the market is pricing in. Even if inflation is persistent, there is a limit to how high bond yields will rise in a world with excess savings looking for a low-risk home. We must, however, point out that the post-pandemic re-rating of equity markets is behind us and that future returns will have to be the result of earnings growth. The environment remains positive for risk assets, but we believe that different markets will come to the fore and that different sectors might outperform going forward. We remain positive about global equities, but we expect a continued rotation out of technology to more cyclical sectors. We also expect emerging markets to outperform developed markets, the East, the West, and Europe, the United States. The biggest risk to the equity market is rising bond yields. We remain skeptical about fixed income where yields are still negligible. We worry about the inflation fears that could trigger a fully fledged sell-off. We remain neutral about property, which, whilst cheaper than pure equities and yielding better than bonds, are. Here at home, government's COVID-19 vaccination program remains stuck in first gear. 2 months after the first consignment of vaccines arrived, less than 0.5% of the population has been vaccinated. Zimbabwe, a failed state with a population a quarter of the size of South Africa's, has managed to vaccinate a similar number of people. To add insult to injury, government has decided to pause the administering of the Johnson & Johnson vaccine after reports that 6 people out of the 6.8 million who had received the vaccine in the United States had developed blood clots. Given this incidence rate, of the 290,000 people vaccinated in South Africa, fewer than 1 person would actually develop blood clots. The South African mortality rate for COVID is 3.42%, which means that if 290,000 people got COVID without a vaccine, 10,000 would die. As Vaughan Cupido would say, go figure. As of Thursday night, nearly 1.6 million South Africans have tested positive for COVID-19 and nearly 54,000 people have succumbed to the disease. The infection and death rates are both rising slowly but surely, and on Thursday, 73 more people died of the disease. Vaccinations have ground to a halt, and the post-Easter third wave is imminent. Gauteng still has the highest cumulative number of infections at 419,000, and the Western Cape the most deaths at 11,500. KwaZulu-Natal has the highest number of active cases at 5,300, as well as the most deaths over the past week at 97. Unemployment levels are dropping, but still higher than before the pandemic. Credit extension is still growing very slowly as households try to get out of debt, and booming mining and agricultural exports are boosting our trade surplus. South Africa might avoid further fuel price increases if the rand stands its ground and new vehicle sales rose in March. SA Rugby is hoping that the British and Irish Lions fans will be able to travel to South Africa to support their team, as it is estimated that a full component of fans would spend around 6.6 billion rand while in South Africa. Despite the rising cost of imported fuel, South Africa's trade surplus grew to 29 billion rand in February. This was due to two factors: increased export earnings thanks to higher commodity prices and record maize and fruit crops, coupled to subdued demand for imported goods. The trade surplus would have been substantially greater had it not been for the higher oil price. Mining companies have responded to the rising demand for metals and minerals by raising production. Unsurprisingly, the sharpest increase was in iron ore output, the green line, prompted by a steep rise in the price of iron and steel on commodity markets. The other commodity which has seen a sharp rise in output in the first quarter was platinum. Coal production was flat, while gold output remains below its pre-pandemic levels. The JSE had a strong week, led upwards by financials. The rand is at its best levels in a year against the US dollar, which is great for consumers but less so for rand hedge shares. Bond yields have come down to below 9.3%, and Anglo American is exiting the thermal coal industry. MTN wants to list its fintech subsidiary, and Kanye Mbao's ex-sugar daddy wants to take over SA Express. Afro-skeptics tend to favor rand hedge stocks over locally focused companies because our economy is stagnant and domestic consumers have limited purchasing power. While this view has merit, there are times when valuations are so far out of kilter that mean reversion occurs and SA Incorporated shares re-rate relative to rand hedges. A prime example of this phenomenon has been playing out over the past 6 months when value-focused investors started giving preference to locally focused shares, the grey line, over rand hedges, the blue line. Foreigners were net sellers of South African bonds last week to the tune of 870 million rand, while the JSE gained a net 100 million rand. For the year to date, the JSE has seen around 8.5 billion rands worth of foreign capital departing, but the bond exchange has already lost more than 30 billion rand. This is equivalent to more than half of the total outflow in 2020. The rand enjoyed a good week against the US dollar and at one stage today tested the 14 rand 20 to the dollar level. These are the local currency's best levels against the greenback in 18 months, and experts see no reason why, barring a major shock, the rand should not remain below 14 rand 50 to the dollar for the remainder of the year. Locally, the equity market has been strong so far this year, but valuations are still fair and prospects for earnings growth look promising. Real bond yields remain attractive, but we remain mindful of risks to the fiscal outlook going forward. We continue to avoid listed property and regard cash merely as a liquidity tool because of the low interest rate it offers. The Adviceworx PCS asset allocation view can be summarized as follows. Because of the economy and the weak rand, we remain overweight global equity and underweight South African equity. We remain neutral on global property where valuations are reasonable, but negative on South African property. We hold no global fixed income, and we remain overweight South African bonds. Thank you very much for your time and attention. We certainly live in interesting times, and I hope that this presentation will help you make sense of them. Should you have any questions or queries, please don't hesitate to contact me or your Adviceworx financial advisor. I hope you'll have a lovely day and a splendid weekend. Until next week, goodbye from me.